This is a preview of the Hedge Heads Insider. Check us out at thehedgeheads.com. The risk of loss in trading commodities can be substantial. These are opinions only and not trading advice.
Well, John, another insider on this Thursday morning. Looks like we're going to have another 60-degree plus day here, but it doesn't look that way for Saturday.
No, it's shifted a little more east, and just keep moving east. Just keep on going.
Oh, Eastern Corn Belt getting slammed with snow. Is that what you're saying?
It's the corn's going to blow down. It happened.
All of it
happened 1 August, but I don't think it's going to happen yet. So one of the things we do also is talk about cash markets, and one would be diesel fuel, heating oil. So you want to look at seasonals for diesel, and we've run down that market. I mean, it's gone down, for the last 2 months? And one would call that a support level, and you have all that on the charts. But we're getting to attractive levels, and we're getting to attractive times of year. So the first big seasonal is at the end of March. First, it's unleaded gas mid-March, and then at the end of March is diesel fuel. It goes straight up into April. This is the seasonal. And then it actually sometime in mid-April goes back down and we start over again. Then there's another seasonal. May tends to be very weak, and then June tends to blast up. So you got a couple really sharp up and downs. But
those were diesel specific. You mentioned both diesel and unleaded, so I just want to be clear.
Yeah, so
that's diesel prices.
Yeah, towards the end of March is diesel. Mid March is the unleaded bottom, seasonally speaking. And so you got two different ones pretty close to each other. So with the diesel, what you want to be doing is, these are very attractive levels. We're getting to a time of year, and we would recommend cash, getting that tank filled on the cash on the farm. So if you're waiting, yes, technically we have 2 more weeks to go on the seasonal, but go ahead and look at the chart and see what's going on. If you feel like it's going to fall for the next 2 weeks, wait. But we are recommending that you look at that cash purchase of filling up the tanks on the farm. This is right in front of the first big seasonal of the year for diesel. So that's something that we do here too, and definitely in the daily updates. On the market insights, the subscription side of stuff will be a little more in depth on that, but it's just been back and forth in soybeans. You wake up every morning, it's a different story.
Right. I noticed that today when I looked. Were they down 17 yesterday? They're up 11 today. Let's just keep. What do we call it? It's not a bull market. It's not a bear market. It's a kangaroo market.
Yeah, it's just tough. I mean, it seems like the calls lose money, the puts lose money, the longs lose money, and the shorts lose money. It's what they call a meat grinder. Now, if you time it perfect, I'm sure there's guys out there listening right now and say, I'm killing it. Yes, there's those guys, but you're going to have to be watching these markets, because you're not going to walk away and expect to make money when it just whips back and forth. But what do we say in the other podcast? We're looking for the opportunities, and one that really jumped at me is soybeans. The implied volatility is fairly low. Yeah, it's not too often you can own an entire summer and all spring and have all the trade deals that could possibly happen. You have problems in spring, problems in summer, very common, and you could own an entire summer. I think the $11 was something like 26 cents yesterday. Today it's going to be a little bit more, but the timing on it is generally you can wait until April. There's really no rush this time of year, no worry this time of year for beans, and it certainly doesn't have any good news. But something to keep your eye on is, again, that premium being as low as it is for beans. It's not historically record-breaking low, but still very affordable this year. Where corn, guys are leaning, hey, should I buy corn calls? I prefer bean calls over corn calls just because of the volatility. When it does pick up, beans tend to outpace corn. I don't know. What's your preference, Ryan?
Yeah, well, I'm going to just talk about volatility a little bit just because options are what I look at. But I did have a conversation with a market maker the other day because he had talked about the closing vol. What was that, Monday or Tuesday? And April's like 15.5%. August was 18. What was November? 18.2 also. So that's low. I mean, Now, historically low? No. But he mentioned that, right now beans go somewhere between 15 and 20. Well, we're well under 20 without any shocks. Going over 20 is high, but I mean, 2 years ago, it was frequently that beans were 20 plus. 3 years ago, 20 plus. And so the vol is definitely low. That leads to cheaper options.
Which it's the opposite for corn. Corn's very expensive, surprisingly expensive, and generally it gets more expensive as you go into spring. It's a little different than soybeans. So I see the deal better in soybeans than corn this year for sure going into the year, but there's a fundamental difference as well that one has to consider. But what I talked about on the insights a little bit yesterday was that the call for beans is a great courage call. And what is a courage call? We'll go over that quickly this morning. So you basically buy this call after market's been beat up and everyone's given up on it and it's cheap, like we were talking about. Not that the market can't go down further, and certainly can, but something happens in the summer and then suddenly that $11 call, though it's right, the futures are right with it. At that point, you can take your profits on your call and sell your beans, and you can combine the two. So now you have your cash beans at $11 that you sell, and then the call you bought for 26 cents. Let's just, for easy math, do 24 cents. So you have a 24-cent profit. You sell it for 50 cents because it's appreciated, and now it's worth 50 cents, and you paid 26. So that's the extra 24 cents. And then you throw that on top of your $11 sale, and you have 24 cash, futures on your beans. Now, the reason why they call it a courage call is the other way you do it is when it gets to $11, you can sell your cash beans or your forward contracted beans at $11, and then keep that call on. And you have your upside wide open still. So you get the best of both worlds. You have the beans sold at $11, and you still have your upside wide open. Now, you can't do that after beans move. You can. You're going to pay up, though. You're going to pay up a lot of premium.
You're going to pay that 50 cents rather than paying 26.
Yeah, and it might be 70 cents. It might be 75. It's hard to know without being, it's depending on the volatility and the situation in the summer that gets you there. It could be $1. You just don't know what that call is going to be worth. But after it goes up and then you start chasing calls, that's why guys don't make money on them oftentimes. They buy it after the story. You have to buy it when everybody hates it. And again, back to the timing of it. Obviously, that's where we would talk with you individually on that and look to time it the best you can. Like, you wouldn't want to buy it now, have beans go down another 50 cents, and then, we could have bought a 10.50 for this 26 cents. So timing is everything there. It's not just you just go out and buy it, but the concept is that you have this thing bought that will cover your upside, and you have the courage to market your grains right when you get there. The main problem guys have in the summer is it's hot and dry. They say it's going to go up forever, and they hang on to their stuff because they have no upside after they sell it.
Or keep adding at those 50 cent calls because it seems like it'll go up forever. The
greed gets a hold of a guy a little bit. So anyway, it's the courage calls. It's the first year that I can remember that's set up fairly well. Not that they wouldn't have worked in the recent past, but still, this is an ideal situation for that strategy. Corn, a little more expensive, but beans, good idea right now. I just have
another comment on there. Yeah, on that bean side. Now, it just because it's set up where it looks good doesn't mean it's going to work. And two, if you're doing more than one contract, this is a great time to start looking at, maybe I want to pull one, I'm going to do 5 contracts. I want to do one right now, or 5 options.
Yeah, you can average yourself in.
And just start kind of averaging in. Again, it might not be today. It depends on how much you're trying to, how many do you want to buy? What's your risk profile? All that stuff. But it is the time to start looking. You don't have to buy 5 on the same day. Is my point.
And we really haven't had this. We haven't had this setup going into spring. Now, guys don't like this setup. It's a lower price going into spring. It's not like you're cheering for the setup, but you got to deal with the market that you're given and look for ideas to help your marketing. You don't also want to make it worse, though. Start buying a whole bunch of calls saying it's going to be a drought, and then make your bean sales $9.50 minus 26 cents. Like that makes it worse.
Rough, yeah.
So timing is still everything. These are just general concepts that we're just trying to get across and apply them to the markets that are happening now. But timing is everything, and that's what hopefully we help with guys personally on the phone, and try to time it a little bit better. Seasonally speaking, like I say, generally we're sideways depending on that March 31st report, it can be, it's not known for it to be really bullish beans or bearish, just as neutral. This year is going to be interesting. That March 31st prospective planting. What's your guess there, Ryan?
I don't have any guesses, and I know I'm going to sit on the sidelines into it.
Come on now. Everybody on Twitter fights about this daily. You have to get in the fray.
I got zero. Sorry. Yeah, absolutely zero.
It's always a relief when that number comes out for me. It gets really annoying, everybody throwing their numbers out and why and inputs and anger and fringe acres. And it's kind of just this controversial report. And I don't think it should be. I think people take it a little too serious.
Yeah. Well, that's probably because they have skin in the game. I think I look forward to the report because it tells me some stuff moving forward.
Yeah.
I mean, I really have no interest in being too involved in the egg markets at all until that report's out.
Yeah, it's always a relief. And then everybody says that's not going to happen anyways. And the cycle just repeats every year. This year, though, honestly, I think they'll weight these numbers a lot more. It's kind of weird. Report where they weight the numbers more in one year over another, and that has to do with weather and snow on the ground. Sometimes it's like a glacier up here in the upper Midwest, and in those years they laugh that report off, especially if it's a high corn number. But this year, snow's gone. I mean, it's got the bomb cyclone's coming, but
snow's gone until Saturday.
Yeah, snow. But it looks like it's not gonna be a lingering issue right now. I probably jinxed it for the 18th time, but we look like we're going to have early spring, and guys are getting nervous about all these big acres, and they should be this year. It's a nice looking year for planting.
I would agree. Speaking of planting and planning, you mentioned corn earlier, and I interrupted you, but I've been watching these corn spreads. What's your read here?
Oh, yeah. Yeah. So the front of corn is now a different market than the back end of corn, and that's